Good afternoon, Quasar Markets Live. Welcome back, and so happy to have Dr. Alan Ellman in the house again today. You give us house calls, Dr. Ellman. I know you didn't do that when you were a dentist, but we appreciate it. Every Tuesday you're here with us, bringing people more and more information about the BCI method. How are you doing today?
Doing great. I always love speaking with you, Howard.
I enjoy our conversations for sure, also. And I appreciate it. You've put together a PowerPoint today. We talked a little bit on our last segment about portfolio overwriting, and if you're worried about your shares getting called away, or other things, reasons why you would do some protection, or why you would maybe have a little bit of a different strategy involved. So, could you talk a little bit about that?
Well, sure. Portfolio overwriting is a form of covered call writing. So I thought that for your viewers that may not be familiar with the basic strategy or the traditional approach to covered call writing, I'd include this slide. So covered call writing is a low risk option selling strategy. So I'm on the sell side of options, where the first step is to buy or perhaps you already own a security, stock, or ETF. So by knowing your cost basis, by owning the stock first before you sell the option, that puts you in a covered or protected position. So once you are in that position, now you're free to sell the option. And when you sell that option, what you're doing, Howard, is you're agreeing to sell your shares at a price that you have determined, known as the strike price, by a date that you've determined, known as the expiration date. And then, of course, the most important step in the procedure is to collect the premium for undertaking that contractual obligation. But now you are obligated to sell your shares at the strike price by the expiration date. The third word in the term covered call writing is writing, which means that you are initiating a sell to open order. So it's an open order where you have the contractual obligation to sell your shares at the strike price. And then once you enter that position, Howard, next thing you do is go into management mode, which may or may not be indicated.
And what I want to point out again, in case we have some new viewers here today, is this strategy, what you're doing, as you've talked about, is providing an extra stream of income by using your investment in the initial, stock, underlying stock that you own. Just so again, we have new viewers, I like to bring them in. For some people, covered call writing is already confusing them.
So portfolio overwriting then is a form of covered call writing. I call it a covered call writing like strategy. It's not traditional covered call writing. In this particular situation, what we're doing is we're assuming now that there's a long-term buy and hold portfolio, typically stocks that are generating dividends that we own at a low cost basis, that are in non-sheltered accounts. So we may not want to sell the shares because we may have some negative capital gains issues to deal with. So what is our goal now? Well, our goal is to leverage these securities, as you just pointed out, to generate additional capital. So, for example, we may set an annualized goal for portfolio overwriting of 4 to 10% a year. Now, that's actually a reasonable example, which would translate that into a 0.5% a month approximately. If we did weekly options, about 0.12% a week. Now, just to give you a frame of reference, Howard, if we were doing traditional, now this is the way I do it. My starting point is an initial return of 2 to 4% a month. That's my starting point. The end result could be either more or less, but that's how I start. If I were doing weeklies, just divide that by 4. But certainly for portfolio overriding, where we're adding in one additional important ingredient, and that is we don't want our shares sold because of the potential negative tax implications.
Yep.
So therefore, we're going to generate lower income by setting strike prices or sales prices much, much higher than current market value. So I call that in this screenshot uh, deep out of the money strikes, low delta strikes, which are much, much higher than current market value. at the time that we initiate these trades. So if we were using delta, a typical example or a reasonable example would be a delta of 10, say anywhere from 10 to 20 would be reasonable. And the last bullet point, Howard, and I stress this probably at every time we get together and speak. I hope you're not getting sick of hearing me
Never.
say this. But we should always avoid earnings report dates because of the risk involved. And there's a big if now. If we don't want our shares sold, we should also avoid ex-dividend dates.
Absolutely. It's so important to keep on mentioning that. And what I'd also point out is, so you're sacrificing a little bit of potential profit for a little bit more of a potential protection from having your shares taken away. Is that correct? That way to look at it?
Perfect way of summarizing it in one sentence. Perfect. You're giving up premium if we're doing it in the traditional manner in exchange for lowering the risk of being subject to exercise. So the higher the strike, the less likely that stock is
Yep.
going to climb all the way up and then go higher than that strike price.
Right.
If it does go higher than the strike price, then it's subject to exercise, but we can always mitigate that as well as
Absolutely, especially with all of your exit strategies and the ways that you have to manage that. Without a doubt, you can still, definitely switch up what you're in to make that happen. Roll some stuff over to a higher strike or whatever. And I think the reason I wanted you to do this one today is because I do think it's important. There are a lot of stocks that are close to all-time highs right now, and there are people that are worried. Are we going to continue to see? Are we going to get a Santa rally here after the next week, or is it going to go the other way? And people are trying to be a little bit more conservative, I think, right now in some covered call strategies, and some of the people I've talked to in the markets right now, because they don't know if you get that rally out of nowhere. Because what we've seen is when we have, you'd have to say the last month's been a little bit more bearish than bullish, and that's when we sometimes see these huge spikes the other way, right?
well, yeah. I mean, if you're doing portfolio overwriting, then just by definition, you're going to use strikes much higher than current market value. But like for example, this week with the Fed announcement, maybe the Fed will make an announcement that will cause your shares to go up a little bit higher than a normal week. So you may want to set your strike price a little bit higher. If you plan on holding on to these shares no matter what, well then you're not worried about it going down a little bit more than typical because you were planning on holding the shares anyway. So in other words, you have to define what your goals are. In the
Absolutely.
case of portfolio overwriting, there are two goals. One, cash, money.
Yep.
You want to generate cash by selling these options. And two, you want to retain the shares.
Yeah.
For traditional covered call writing, your goal is mainly the cash. And like I said previously with you, Howard, if my shares are taken away early, exercised early, which is very rare, I'm a happy camper because
Yeah.
that means I utilize my trade and now I have all this cash back to then utilize to generate a second income stream in the same contract cycle.
It's funny you bring that up because I'm in a just a not cash covered call, but a regular, a covered call spread, debit spread. And I'm at that rate where I'm saying I don't know that I can tweak much more out of is what I can get still to the upside worth my money being held up for another week or two. So I think that's an important part of investing that a lot of people don't look at. And what I love about your system is that you look at it like almost as a real estate investment, and your time money frame there and being able to reallocate that money becomes important, especially when you're using options as a stream of income.
Yeah, I mean, sometimes like you say, you've maximized your trade and it's still relatively earlier in the contract, and you say to yourself, well, is there any way I can get more than a maximum return with this particular cash investment? And the answer is there are many times when you can. So the guideline that I use, Howard, regarding this particular situation is the following. If I close both legs of the covered call trade, and there is going to be some time value cost to close, right? If I close both legs of that covered call trade, now this won't apply to portfolio overwriting because here we want to keep the shares. But
Yeah.
let's say traditional now, then The guideline in BCI methodology is if I could take that cash and generate more than 1% over and above what it costs me to close, then it pays to close both legs of the trade. In other words, if it costs me a 0.5% to close, can I generate at least 1.5% more by closing both legs and using that cash in another covered call
You
trade?
see me writing that note down. I love it. I love it. I love it. I plan on stealing that for when I make my decision today on my Mara trade. But that, yeah, like I said, I'm very lucky to work with a lot of experienced and intelligent investors that are now educators, and I'm learning so many things, and I really never looked at that as one of the sides before until I was reading through your PowerPoints one day, and I said, I really got to take a look at that because it's true. Is there are so many times where I know something, let's say I've had a $5 spread on a debit spread or something, and I knew it was going to fall in the middle, and I'm just happy, and I say, okay, we'll see where it falls, where I might have been able to do it, or I've looked at and done it with this Mara one based on yours, is I sort of used the book that I bought of yours, and I rolled one end of it to a higher strike and took some more profit and was able to play it that way to give myself more room. So it, like you've always said, it is not one stop shopping, and not everybody's situation is the same.
Yeah, it's amazing when you know how to manage your trades, how much more cash you can generate and how much higher your percent returns are going to be if you take advantage of those scenarios when they come up.
Absolutely. Without a doubt. Okay, so let's talk a little bit about how you do decide on your strike selections.
Well, there are different ways of doing it. I'm going to focus in on delta today,
Okay.
but one way to do it is just to focus in, and we talked about this a little bit before, on what is your goal? I mean, you can't set up a trade unless you know what you're trying to achieve. Now, I told you before that when I'm doing traditional, and if I'm doing monthlies, it's 2 to 4% a month. I'll go up to, but not beyond 6% in a raging bull market, but in a typical market, 2 to 4%. Divide that by 4 for weeklies. But for portfolio overwriting, it's going to be much less because we want the added protection of a deeper out of the money or much higher strike price. So here a reasonable goal would be about a 0.5% a month or 0.12% a week. But you have to identify your goal before you enter your trade. Otherwise, how the heck are you going to know what strike to select?
Absolutely.
Now,
We talk about that and it sounds so simple, but I can't tell you the amount of investors that don't take that step, that just say, I think stock X is going to go up. And then, especially if you're playing with options and not looking at the Greeks and the particulars of it, you're really not maximizing what you're doing.
well, that's true. I mean, one of the questions that I get all the time is what delta should I select for my strike? You know, what delta? So, like, is it 30? Is it 35? Well, they're not, that takes off the table what is your goal? And
Right.
it also takes off the table using deeper out of the money strikes like we'd be using here that would have deltas of maybe 10.
Right.
And it also takes off the table in the money strikes, which have deltas of between 50 and 100.
Yeah.
So you can't like put yourself in a corner where you're only using one delta or let's say 1 or 2 strikes above current market value, which so many covered call writers do, and missing out on scenarios where they can actually craft the trade to what their specific goals are. But in the case of portfolio overwriting, Howard, they're always out of the money.
Right.
Always. I mean,
Absolutely.
that's specific for this strategy. And that will reduce the likelihood of exercise or the need for exit strategies. Still might need to do exit strategies, but it'll be much, much less if you go out of the money and then, of course, deeper out of the money.
Absolutely. Makes sense.
Now, also, we could use certain statistics to actually measure our risk or the chance of exercise. And two of the ways of doing that is delta and implied volatility. Today I'm going to focus in on delta. If you'd like, another time we could talk about implied volatility.
I love to. I
Uh,
love to, especially because it's a big part, I assume, of you selling premiums at higher. You sell volatility usually, right? You don't want to buy it.
right, and we can also craft. We can actually use conversion formulas with implied volatility to get a trading range with an 84% probability of accuracy.
Wow.
And people will settle for 16% risk with their trades, and that doesn't
Yeah.
even include integrating exit strategies, which will lower that 16%.
And
But
that's why I'm so amazed by your strategy, the systems you've put in place, because it does provide this extra ability to manage your trades, but also, like you said, if you set up at the beginning what your goals are, it allows you a clear, what I would call, vision into executing it, which is not easy to do when you're just looking at charts and doing stuff on your own. Having that ability to have a guideline to start out with, setting your parameters that you're looking to start with, then following them, but then also having the strategy, I just can't tell you how impressed I am with it.
But you know what, Howard? To your viewers, I have to say this. What you just said now, knowing how to enter a trade, knowing your parameters, and then knowing how to manage your trades, I just want your viewers to envision in their minds how much confidence they can have entering a trade, knowing, you know what? I know I'm entering. I mean, not every trade is going to be a winning trade, but I know I have all the parameters here for this to be a winning trade most of the time. Not all the time, but most of the time. And then on top of that, if things turn against me or turn out way better than anticipated, I know exactly how to mitigate those losses, and I know exactly how to enhance those gains. Imagine the confidence level that you'll have if
Oh
you if
yeah.
you're which is what Quasar is doing with these kind of events, educating people, investors, so they can maximize their returns.
Absolutely. You can turn losers into winners like you've talked about more times than not. You can, and you can eke out higher profits on almost every trade with all of the tools that you've said. Like I said, it's opened my eyes into so many things that I do, just with my little covered calls or debit spreads or put spreads or whatever it might be. And then, between yourself and there's another gentleman, Jeremy Vreeland, that I have on a lot that talks about this. And roll sometimes it might not even be intuitive to you, but what I've seen is your plans, just reading your book and following them, you make it intuitive. So you really raise up, you're teaching people how to fish, not just showing them. There are so many of these services that say, hey, I'm telling you today to buy Microsoft at 245 and we're going to sell it at X. You're teaching people to choose those stocks and do it on their own.
Yeah, and it sounds a little intimidating initially if you're new to options, but it's the kind of thing that after a while it'll become very much second nature to you. Your confidence will grow, and then after a while you'll just know what to do. You'll know how to react, and then you have years and decades to benefit.
Yeah, like I said, when I was teaching at Prosper, I used to love it when you'd see that student where it went off, where you could see the light went off, and they no longer looked at you as a crutch, but more as as a sounding board. And that when that changes, it's a big difference. It's awesome to see in your clients, at least for me.
Yeah, yeah, definitely. So what happens, Howard, if let's say you've used all of the information, all of the education to select a strike that has a very low probability of expiring in the money and be subject to exercise, and yet that stock went up and up and up, and then past that strike, leaving the strike now in the money. Initially, it was out of the money higher. Now it's in the money lower. What do you do? Well, the answer is really easy for this one, and that's simply to roll the option. And rolling the option just means you buy it back prior to 4 p.m. Eastern Time on expiration Friday, buy back the option, and then sell the next cycle. You could do weeklies, you could do monthlies, same strike or higher strike. So if you roll out, let's say from the April 50 to the May 50, that's called rolling out. So a later date, same strike. Or you could roll out and up, which is what you're more likely to do with
Yeah.
portfolio overwriting, where you buy back the April 50 and you roll out and up to the May 55. So that will avoid exercise for your portfolio overwriting strategy, and your shares will not be taken away the Saturday after expiration Friday. Very easy solution to this particular issue.
Weird question I have for you. Do you ever go from monthly to weekly in between because of something happens? Does that ever
Yes,
change for you how you roll?
yes, I
Okay.
do. I will switch to weekly options if I'm doing monthlies and there's an upcoming earnings report, or for portfolio overwriting an upcoming ex-dividend date. Let's say the earnings or ex-dividend dates come in the third week of a monthly contract. What I'll do in those scenarios is I'll sell weeklies week 1 and 2. I'll be out of the trade. I'll still own the stock for portfolio overwriting, but I will not have an option in place in week 3. Now, if it's Monday, I'll put it back in on Tuesday, something like that. And then I'll go back to weeklies on week 4, and then back to monthlies after that, or stick
Okay.
with weekly. But yeah, that's when I would go from monthlies to weeklies to circumnavigate earnings report dates or ex-dividend dates if I want to retain the shares.
And that's what I love. It's so flexible to use. That's the other thing I've noticed is when you look at some other people's programs out there that I've dealt with, because they don't have 30 years of doing this, it's a very rigid system. So if they use a monthly, they never switch from a monthly if they do this because they haven't had the years to go back. And a lot of people, again, not to pat yourself on the back too much, but the fact that you go back and look at all these trades and do it, a lot of people in your position don't. They say, I have a system, it works good enough, we'll use it. But you talk to me all the time about how you go back and look at it and say, what could I have done on this one to do better? Um, you don't see that a lot. You really don't.
Well, Howard, I started out not in the business, let's say. I was a dentist in my first career. I was doing this for myself and my family. So losing money wasn't particularly attractive to me. So
No.
when I had a losing trade, I really investigated. How could I have avoided that? How could I have lost less? How could I have maybe turned the loser into a winner? So everything that you're seeing now with BCI is what I did when I was still thinking that my final professional career was going to be as a dentist, and it
Right.
turned out I was wrong. But that's the information now that I'm providing to all of our members, and of course Quasar as well. I love
Absolutely.
participating in these discussions with you.
We love having you here. So let's talk about Apple here going into a dividend.
Well, I want to show you viewers how you can access the ex-dividend and earnings report dates. Of course, if you're a member of the Blue Collar Investor, we do this for you. But if you're not and you want to find out when the X dates are, one reliable source that we've been using for many, many years now is dividendinvestor.com. You don't have to be a member. You don't have to pay for it. Just put in the ticker symbol and you'll get information like for this Apple example, you'll see on the top left, Apple gives a dividend. It's a very small one, but 0.41% at the time that I made this screenshot, which was a few days ago. And it gives you the ex dividend date. So in this particular case, it gives you the last ex date, which was November 8th. So you can assume the next one's going to come 3 months later.
Later.
And this gives additional information, like I just highlighted two of the rows at the bottom. Most companies that do give dividends, it's quarterly. And you can see Apple's been giving dividends now for 34 years, so you can pretty much assume it's going to keep going. So that's the kind of information that you get at this dividendinvestor.com site.
Yeah, that does give you everything you need to kind of get an idea of what is going on within the dividends for the company, for sure. I've not used that one. I like that.
Now, for earnings reports, there are a lot of good ones. Zacks.com is one. The
Yeah.
one I'm showing here is earningswhispers.com. And you just put the ticker symbol in where you see that pink arrow at the top. And then at the bottom left, it'll show you that the next earnings date for Apple is after market closes on January 30th. So
Yeah.
you'll know not to have an option in place on January 30th.
Yeah, it makes it so easy nowadays. You shouldn't, knock on wood, have any excuse for not knowing those days coming. If you're using TradingView, a lot of those companies, like on my charts, they're right on the chart. It gives you the earning date and a big, red square down the bottom that tells you it's coming. And the same thing for dividends, I think, are in green. So that definitely those things are important. Again, when I first started trading, I didn't look at either of those. And now I realize, after getting beat up by them a few dozen times, you realize how important they are. So it definitely is, something to keep in mind. Information is so important. We see that. That's what Quasar. I will say all of that stuff can be found on the Quasar website also. We do have all earnings reports coming up, all economic data, both here in the U.S., where you can select your nation for it. So, you definitely can get that stuff at quasarmarkets.com also.
Excellent. So before we give you a real life example, Howard, I just want to summarize if that's
Yeah,
okay.
absolutely.
Portfolio overwriting applies to long-term buy and hold portfolios. Typically, shares are at a low cost basis. So if you bought a stock at 20 and today it's 200, you sell it, you're going to have to pay tax on that. You may not want to do that. So again, these apply to non-sheltered accounts. Now, you want to generate higher returns than the shares are in and of themselves, but you also want to avoid exercise. You want to retain the shares. So again, to talk about the rolling the options, if an option is expiring in the money, you could roll it out or roll it out and up. And as far as ex-dividend dates are concerned, you could sell the option on the X date or after the X date. If you're doing monthlies and they don't have weekly options, you can go out 2 months, and very rarely will the next date cause exercise.
Right.
Uh, Weekly options are an excellent way to circumvent both earnings and ex-dividend dates. And finally, you have to understand what your goals are for portfolio overwriting. I feel like 4% to 10% a year is reasonable. I'm going to show you the low end of the spectrum
Okay.
in this particular discussion. But for traditional, my goal, which doesn't mean that everybody should use it, but my goal is 2 to 4% a month for my initial time value return, and whether that's out of the money or in the money, that is my goal, and so I select the strike based on that.
Absolutely. What I will say is, your strategy is a beneficiary of what we've seen in the markets where there has been this change to more and more weekly options expiries, right? That sort of, has just increased and increased over the last few years. And I think we're going to just see more and more of a move into that, right?
Weekly options. I'm myself doing more weeklies than I did years ago,
Yeah.
and that's partially a product of the fact that there are more underlying securities that are associated with weekly
Yeah.
options.
More offers and more liquidity.
Right, and there's more liquidity. So, yeah, there's more opportunities with weeklies. The question is, with weeklies, you are going to have to dedicate a little more time
Absolutely.
to weeklies. So, if you're working two jobs and raising three kids, you may say monthlies are better for me. Both work great. Weeklies will, I believe, will ultimately result in higher annualized returns, but will also require a little more time and effort. And the base of securities that have weeklies still not as many
Not
as
as
that.
perfect, right? It's getting there, and it's going to open more and more. I think you're going to see it. I have to ask one more question before we go on. That's I don't mean to sneak up on you here, but how is like the advent of zero DTEs moved into this and
I don't,
brought it
I
in?
don't, I don't do those. I know that there's a lot of people that like day trading, and I can't really say use it or don't use it because I haven't myself used it. And one of the reasons I didn't use weeklies early on is because I felt like if the trade turned against me, I wouldn't have enough time to manage it. I probably would hate doing day trading.
I more meant is, are you seeing it change the option market, and have you had to adjust your strategy more as the zero DTE came in more into play? Because now, like the S&P, over 54% of contracts on SPY are zero DTE now.
No, not the kind of securities that I've been
Okay.
using. I haven't noticed. The only thing I can tell you is kind of what you alluded to a little bit before, that there has been a huge growth in the weekly markets and an enhancement of the liquidity.
Okay.
So we're getting a more favorable trade executions than we did several years ago.
Awesome. I mean, that's yeah. I mean, that would be my takeaway. That would be the answer. Yeah, that's great. That it is spread getting those spreads a little bit tighter, and that makes it a little easier to do it. Um, yeah, I was just curious. I didn't know. I always look to see if there's another causation or effect that comes from some of these changes in the market that we see in the structures, and that's been a big change. That investors are having to deal with is zero DTE and the volatility it provides. Like you said, you're not really looking at those Nvidia's as much as some of these others, I think, also, in looking at the
I,
criterias.
I definitely use NVIDIA as one of my
Oh
underlying.
yeah.
It's not always on my watch list,
Right.
but when it does pass all my screens and it's on there, especially when it had the stock split,
Right.
which made it much more usable to the retail investor community. A lot of my followers, members, were saying, why is it Nvidia split? I can't afford to, spend whatever. I have to refinance my home, and then of course then it had the big split. Now a lot of our members are using it. They usually wait for it to pass all of our screens, but once it does, but it is a good underlying to use. I
Yeah.
I use it a lot when I send sample trades out to my members. I've used NVIDIA quite a bit. It's got decent implied volatility, therefore
Sure.
you get decent returns, and it usually goes in the right direction. Not always, but
That'd be
yeah,
another
but
thing that I'll be interested to watch over the next few years is we are still seeing at this point at least the interest for companies to split stock when they get too expensive. But we're also seeing more and more companies or brokerages that are selling percentages of shares. So I wonder how that's going to play out over the longer term because that would have a more outsized impact on how you guys on how your strategy works a little bit.
I didn't do any research on this, but it seems to me that many, many years ago when I first started, there were a lot of stocks splitting, and then there was a time period where no stocks was splitting, and now it seems like it's kind of coming back a little bit again. It just gives the retail investor an opportunity to buy shares in 100-share increments, which means that they then would be able to use these
Yeah,
strategies.
I mean, for me, I think it's amazing. That's what I hope for. I wish they wouldn't be. I understand Berkshire Hathaway and his whole philosophy with his A shares and all that. I get it, but you want people, because what we've seen, and Steve and I were talking about it this morning on our show, is we're seeing even more and more of a difference between the haves and the have-nots in the U.S. And what happens is when they make this unattainable for some of us, I can't buy personally, like you said, I can't play around with Nvidia at $400 or MicroStrategy if I decided I wanted to do that at $410. Like you said, I'd have to put up a second mortgage on my home, unfortunately, to get into a spot to do a covered call. You know, so I do hope that we continue to see it.
Not only that, but one of the important factors that will help lead to our success is to be appropriately diversified.
Right.
So even if you could afford to do covered calls with one or two of these multi-hundred-dollar per share companies, it's going to restrict the diversification that you could do. Now, one of the reports we provide to our members is the exchange traded fund report, and many, many of those are priced under $50.
Yeah.
Quality ETFs priced under $50 that have good liquidity, that have beaten the S&P in both 1 and 3 month time frames. So if you look, you can find quality underlines that don't cost $500 a share. But I agree with you. I hope for the sake of the retail investor market that more companies that have pricey shares would do these splits more frequently.
Absolutely. Okay, so let's talk about your three approaches here.
Okay, we mentioned implied volatility as a potential topic for a future discussion. We're going to focus in on delta, and there are three definitions of delta. The one that applies here is the approximate probability of an option expiring in the money or with intrinsic value. So, of course, when you're doing portfolio overwriting and the stock price is here and the strike is way up here, then in order for it to expire in the money, the stock price would have to go all the way up and beyond that out of the money strike, which is now in the money. So if it has a delta of 10, what that means is it's approximately a 10% probability of expiring in the money, which we don't want. So the risk factor would be approximately 10%. Notice I'm using the word approximately a lot here. Uh, not precise. And then we have to identify our goals. In this case, we're going to use 4 to 10%. As I told you earlier, the example I'm going to show you is at the very low end of the range, the 4% range. But that will, with these particular scenarios, depending on the delta you select, and in other words, how much risk you're willing to take of expiring in the money, you can go up to 10%.
Okay.
So here's an option chain that I created on December 10th, so last week. At the time, Apple was trading at 245.79. No earnings report or ex-dividend date in the way. We're going to go out 32 days to January 10th, expiration. And we're going to look at the 260 and 265 strikes. So I circled in red the deltas. So one has about 15% delta, the other has an 8% delta. Now, typically 8% deltas, in other words, 92% probability of not expiring in the money. Usually those won't generate the 0.5% a month we're looking for. They
Right.
won't. So in this case, we more likely will go to that 260, which is going to get us just at the low end, or maybe even 255. Now, if you look at the delta of the 255, that means there's a risk factor of 26%,
Yeah.
74% probability of not expiring in the money. So the odds are still pretty good with that 255, but I'm going to be conservative and we're going to look at that 260. I'm going to show you calculations on both and why the 265 may not generate what we're looking for, but those are the two. And we would probably select the 255 or the 260. And if you look at the bid column, if you can go back just
Whoops,
for a
sorry
second.
about that. I didn't mean to hit that.
If you look at the bid column where in the pink cell there, you
Yeah,
can see that the 260 strike had a bid price of 83 cents, narrow bid ask spread only 6 cents, and the 265, 41 cents bid ask spread of only 3 cents. So, obviously there's a lot of interest in Apple options. So
absolutely.
83 and 41 is what we're going to use. Now we're going to put that into the trade management calculator. Next slide. And just to remind your viewers who may have watched some of our previous discussions, what you're going to see from this spreadsheet is the entry into the blue cells on the top left, covered call section, and I'm going to piggyback that on top of the white cells to the right of that, and you're going to get the trade entry, and then you're going to get the initial calculations. Okay, so that's what you're going to be seeing from the Trade Management Calculator TMC
Okay.
spreadsheet. So if we can move on now,
Yep.
you can see on the top, these are the entries. You remember the 260 and 265 deep out of the money strikes. One generated 83 cents and the other one generated 41 cents. So the 260 are in the yellow cells at the bottom and the 265 are in the brown cells at the bottom. Now the spreadsheet shows us that if taken through expiration, in the red circle, it's 32-day trade. And if we look at the yellow cells where the arrow is, the annualized return on that 260 is right at the bottom of our 4 to 10% goal,
Right.
right? 3.25. So that's probably what we would select. Now, I just want you to notice, excuse me, circled in purple are the upside potential. So even though it says, well, you're only getting about a 4% annualized return, your viewers have to remember this is over and above share appreciation.
Creation. Yeah.
So in this particular contract, there's an opportunity to get well over a 6% return. Most of it is share appreciation, but we're putting in another 4% annualized return by selling the deep out of the money option. Now, the 265 strike, which had that 8% delta, you could see that only gave an annualized return of 1.9%. So we probably would not have selected that.
Right.
Some people might have, saying, you know what, 2% is fine with me. I want to give Apple even more of a chance to go higher,
Sure.
almost an 8% upside. So you could look at the calculations. You could determine the risk, 8%, or the other one I think was 14 or 14%, yeah,
14%.
13.
Yeah.
So, and then you can make your determinations. Like you said earlier, in all your brilliance, one size does not fit all.
Yeah, no, absolutely, and like you said, for some people, the tax ramifications can be, ginormous on something like an Apple or an Nvidia that's run. If you've owned it 6, 7, 8 years, that makes a big difference in your portfolio, especially this time of the year, right?
Yeah, and again, you can always roll the option if it is expiring in the money. Early exercise is very rare, but you have to say to yourself, you know what? Once in a blue moon, I mean, I can count on one hand in 30 years when this happened to me. when I got exercise that I didn't expect it. But you have to say, well, that might happen. It's probably not, but it might happen.
Yeah.
So
I've never seen it. I don't have nearly the experience with it, but I have never seen it personally. I traded, not nearly the amount of options you do, but like you said, it's that rare. I have one friend who did it once. I was talking to someone and he did it, and then after Steven, Big Beat almost beat him up, he'll never do it again. The guy, he's like, what was your reasoning there? Like there was none, you know.
here's
And,
what can happen. Here's the reason why it happens: investor error.
Yeah, and that's what this basically was. The guy didn't know what he really was doing. He really didn't. Unfortunately, and that's why we do this every week. That's why I do this on a daily basis. Why you do this on a daily basis is trying to educate retail traders, so you don't make mistakes. Because especially when you play with options, they expire worthless. Like explaining that to people, not in your system and what you do, but you want it to expire worthless mostly, but in the world of options, people don't realize that if you don't own that underlying equity, it can go to zero. It does go to zero, and that's because that's what I've heard by so many retail traders that will come to me, and they when I worked at Prosper, and they'd say, but I always heard it never can go to zero. What happened? Yeah, if you buy actual stock, it rarely goes to zero. If you buy
Yeah, but
underlying options, it always goes to zero if it doesn't hit the number. So
well, Howard, if you have a stock that goes to zero, that's on you.
yeah, absolutely. Well, sometimes it's on the government too. I'd say I was using Save as an example. I was just, not that I played around with it when they were in trouble. But so many people don't understand though. People didn't understand that when that got delisted, there was no value. That the stockholders, people felt like when the company, oh well, they'll declare bankruptcy and I'll get my piece. No, the stock got delisted and the stockholder has no recourse.
Yeah, Enron, Bear Stearns. I mean, there were
It's just
opportunities to get out, but everybody kept saying it'll come back. It'll
yeah.
definitely come back.
Yeah, and that's what again, I'm in a lot of those Reddit groups and Facebook groups and and you see these people that were like, "Well, I'm buying because of XYZ." And I'm like, it's just a flawed, view of things because that's not how it works. And then what people didn't understand is then you had some people who made some money buying those crypto ones that went under and then did actually go through bankruptcy court and they got their money back and people didn't realize there was a difference and there is when it comes to stock and equities when it's delisted. That's the end of it.
Yeah,
So let's wrap up what we have here, Mr. Ellman.
sure. Um, Portfolio overwriting is a covered call writing like strategy, and it's a way of advancing long-term buy and hold portfolio values. In non-sheltered accounts, we want to avoid exercise because of the possible negative tax consequences.
Right.
We want to avoid ex-dividend dates, the most common reason for early exercise, and we always want to avoid earnings dates when we're doing covered call writing, any form of covered call writing. And
Absolutely.
I added this last bullet, Howard, because when we talk about it, I know a lot of times it seems like a panacea that, nothing can go wrong. And I always try to be careful to say it's a low risk, not a no risk strategy.
Yeah.
And there are pros and cons to every single strategy in the world. One of the disadvantages of covered call writing is that the share appreciation is limited by that out of the money strike price. So, when you decide on a strategy that's right for you and your family, you have to know not only the advantages of it, but also the disadvantages. But as a final statement here, if you know what you're doing with covered call writing and you know what stocks to select and you know what options to select and you know how to manage your trades, that you will have many, many, many more winners than losers, and you'll put yourself in an opportunity to potentially beat the market on a consistent basis and many, many years significantly. That's what I have learned doing this strategy now for 30 years.
Yeah, I can't argue with that at all, based upon the success and what I've seen already in your systems, and like you said, not every style is for every type of investor. And the other thing that I would point out to people is adopting a system like BCI for a percentage of your portfolio is not a bad idea also. That's another thing that I often have to talk to new traders about, is it isn't one size fits all for your portfolio. You need, like you said, diversification. And part of that diversification might be I take 50% of my allocation and I put that towards this covered call BCI strategy. And then I take 20% and I do X, Y, and Z with that. And this other, 10. And that, to me, from an outsider, would say is the way that I also tell people that they should diversify, is it's not all one strategy maybe for you, because there is different percentages depending on how old you are, where you are in your life. You might want to be risky with 20% of your portfolio or 0%. And that's how you have to make those decisions.
Yeah, very, very wise advice. Diversification is very important, and people have to make a decision. I mean, covered call writing, is probably the most attractive option strategy for retail investors,
Yeah.
and should be their starting points. But they may end up with something else, or they may end up like I did, trying everything else and coming back to covered call writing. So you have to decide if it's the right strategy for you, and then, as you said, what percentage of my portfolio am I going to allocate to covered call writing?
Absolutely. Well, thank you so much, Dr. Ellman. Again, a great, great interview. I can't wait to share this tomorrow with our viewers, and they can always find it both on the quasarmarkets.com website or on our YouTube station, which is youtube.com at Quasar Markets Live. Uh, have a great week, Dr. Ellman, and we'll see you next Monday.
Take care, Howard.